Bonjour, mesdames et messieurs. Bienvenue à cette première activité de la chaire Wilson. Mon nom est Vincent Gautret, pour ceux qui ne me connaissent pas. Je suis titulaire de cette chaire Wilson qui, à chaque année, vous savez, organise un certain nombre d'activités, mais celle-ci étant une fois la première. So you will notice that the activity is very early in the fall session this year, but in fact we would like to take advantage of the visit of Nikita Aggarwal, a researcher at the Digital Ethics Lab at Oxford University in the UK, and her again after a first meeting we have, I think it was last May in Roma. In fact, Nikita and I were invited to the same panel organized last May, a panel organized jointly by Unidroit and Uncitral, which is an international organization in charge of business law in the world. And these two organizations would like to study how artificial intelligence should be considered by in the future, and particularly in international conventions. So I'm sure we'll see the result of these discussions in the next 20 or 30 next years, because as you see, as you know, it's always a very long process before arriving to a concrete paper or conventions or treaty. So before waiting all these years, I want to hear Nikita again, who is working like many other people in the lab on these AI issues. Specifically, the topic Nikita had chosen to address today is, and I read, algorithmic credit scoring and the regulation of consumer credit markets, which is a very interesting and increasingly common illustration of the interaction, as I mentioned a few minutes ago, between business law and technology. So, as is a tradition, I would like to say a few words about our main speakers. Nikita Aggarwal is a researcher associated to the Digital Ethics Lab, as well as a research fellow and doctoral candidate at the Faculty of Law in the same institution. Her research examines changes to the regulatory landscape occasioned by the proliferation of data-driven technology, particularly due to advances in machine learning. So we speak for sure for artificial intelligence. Another area of interest include internet policy and regulation more generally, as well as the ethics of data-driven technology. Prior to entering academia, Nikita was an attorney in the legal department of the FME, International Monetary Fund, where she advised on financial sector law reform in the Euro area and worked intensively on initiatives to reform the legal and policy framework for sovereign debt restructuring. She previously practiced as an associate with Clifford Chance LLP, where she specialized in EU financial regulations and sovereign debt restructuring. She earned a law degree from the London School of Economics and Political Science, and is the Solicitor of England and Wales. So, as you see, we were supposed to be in the program that I put online on the website of CPT and the Wilson Chair. We're supposed to have two different speakers, but unfortunately we received just a few days ago email of Ignacio Cufoni, Professor Ignacio Cufoni, and Ignacio just forgot he was in Washington today, and so he told us that his plane is supposed to arrive at noon, so for sure he will be here at the beginning of the conference, and if we're very lucky, we'll see at the end, but I think it was, we're in good hands for 30 or 40 next minutes, just with Nikita, and for sure we have some more time to exchange on the presentation after that. So, thanks again, Nikita. I just want to mention very last points. First, I would like to thank my colleagues and friend Pierre Lenoir, which is the director of CIPP. people who know the Wilson Chaire know we have a lot of cooperation with CIPP for many years. Each year a couple of joint conferences. It was a pleasure to represent. And even if I'm pretty sure that people will do that, you have some paper at the end of the room for people who want some CLE accreditations. So you have to sign, it's a formal obligation to sign and to put, I think, your number as a lawyer or a notary, and you will send the accreditation by email. So thanks to be here. Nikita, you have the floor. Thanks again. So Mike is supposed to be here. What do you prefer?
Okay, yeah, I can stay here.
Yeah.
Can everyone hear me? Okay, so thank you, Vincent, for that lovely introduction. My name is Nikita Aggarwal, as you all know. I'm a, and if I try once to check that you can all hear me at the back. Yeah, okay, good. So I don't want to stay too close together. So I'm a researcher at the University of Oxford. I have a few different hats, but I'm affiliated with the Faculty of Law and the Oxford Internet Institute, where we have a lab focusing on digital ethics, and I'm a member of that lab. Before we begin to discuss this topic, I actually want to pay a quick tribute to someone who passed away last week, and who, not only because he's a heavyweight in the field of law and technology, but because he actually really influenced the way I think about this topic. And I'm speaking, of course, of Professor Ian Chaire, who was at the University of Ottawa. I only met him a few times, but he, in his infinite wisdom, managed to impress upon me the importance of the relative value of framing and analysis. I think I was complaining that I didn't have any deep theoretical insight that I thought was particularly novel. And he, in sort of a note of consolation, went out of his way to say that it doesn't have to be something new that you're saying about the topic. It's a new way of packaging and framing it for people to understand. And I hope I'm on the right track in honoring that advice. Okay, so the topic that we're going to talk about today is algorithmic credit scoring and the regulation of consumer credit markets. There are sort of three parts to this is a paper and something that I'll be making publicly available soon. And there are three parts to the paper, essentially. The first looks at, well, what is algorithmic credit scoring? What is this phenomenon? How has it come about, and why should we care about it? The second part is to say, well, what is the impact of algorithmic credit scoring on consumer credit markets? And then the third part is to say, well, now that we have this sort of socio-technological phenomenon, what should we do about regulating these markets, and how should we think about consumer credit regulation differently, if at all? So I want to address each of these areas in turn. So to start off with, what is algorithmic credit scoring? Now, I use the term algorithmic credit scoring. It's not exclusive. We could easily talk about social credit scoring, and that's certainly something that's perhaps more zeitgeisty, if you like, given the developments and sort of the nature of this phenomenon in China. But I'll stick with algorithmic credit scoring for the time being. I think the first point to impress upon you is that this isn't an entirely new phenomenon. It's part of a continuum where you've seen consumer credit, I focus on consumer credit, go from being a market in which a borrower would be assessed face-to-face by a lender, and it would be highly judgmental based on what that lender knows about your family, what you're wearing, etc. This is, maybe we go back 60, 70 years. In the time since, we've had a number of developments that bring us to algorithmic credit scoring as today, but it's preceded by a number of developments. And the key developments in that respect are the introduction of credit scoring as such, and that means the use of statistical analysis to assess credit worthiness of a borrower. So you go from a pure face-to-face, largely personal, judgmental analysis to looking at data of the broader group and patterns in that group to assess whether or not a borrower should get credit, and in turn the price of that credit. And then the second major development that precedes algorithmic credit scoring is the development of a credit information market, right? So if you go back to kind of a classical model of consumer credit markets, it would say, well, there's a huge informational asymmetry because I, the borrower, know everything about my ability and willingness to pay, and you, the lender, you don't really know. So you have this informational asymmetry, and a model like this, sort of Stiglitz and Weiss, would have predicted that there would be a market failure because you have adverse selection and moral hazard effects. But of course, since then, we've had developments in the credit information market, namely that from two directions. One, that consumers provide information to lenders, but more importantly, you have the development of credit reference agencies that gather information and share that amongst lenders. And so some of that informational asymmetry was already starting to ebb away prior to this development. So then what is new? What is the development that we're talking about today? Continuing on from the sort of growth of credit information and the use of statistical techniques for credit scoring, what I refer to in the context of algorithmic credit scoring is the idea of using new types of data, new forms of data, so what we can call alternative data, and new techniques for analyzing that data. And in particular, I'm interested in the use of machine learning tools to carry out the same statistical analysis, but which offers to analyze different types of data in a way that was not previously possible. So there are two dimensions of change. One in the type of data that we're using, and two in the types of analytical techniques that we're using to assess that data and therefore the creditworthiness of a borrower. And what do I mean by alternative data? I mean, so what we're seeing increasingly is that lenders are using social data, so a person's social media activity, behavioral data, including how a borrower interacts with the lender's website. So for example, have they filled out the form all in lower caps? Did they adjust so if you have a risk appetite marker, have they moved it too many times, and does that indicate that they are kind of uncertain? Does it indicate something about their level of education? Now we can definitely analyze and criticize whether those are reasonable grounds on which to draw inferences about a person's creditworthiness or their character more generally, but anecdotally at least we're aware that several lenders are analyzing as much information, as much data as they can gather. Importantly, a lot of this data is more complex. It's unstructured data, it's high dimensional data, and that's where the second dimension comes in, right? That sort of a simple logistic regression wouldn't allow you to analyze that data in much depth, but using machine learning tools, we are able to draw insights from them, particularly deep learning using neural nets. Now, those techniques also have their downsides, which we can come on to discuss, in terms of explainability and understanding exactly what weights were given to different factors, what inferences are being drawn in a way that is more obvious using simple kind of logistic techniques. So this is algorithmic credit scoring. What impact does this have on consumer credit markets? So I want to suggest that amongst many different effects, one of the key things that we need to focus on, and that I focus on in this paper, is the impact of algorithmic scoring on that informational asymmetry that I described earlier. And so in consumer credit markets, we think of there are two directionally opposite informational asymmetries. One is we can call creditor ignorance asymmetry, and this is from Hines and Posner, that says that the creditor knows less about the borrower. This is a classical model of consumer credit markets. The lender knows less than the borrower knows about themselves. The other informational asymmetry, which we'll come on to discuss, is consumer ignorance asymmetry. And paradoxical as it may sound, what that refers to is the fact that the lender has more knowledge about the terms of the product and how they perform over time because they have data and information from multiple borrowers and they have repeat experience. You probably will only get a mortgage once in your life, whereas a lender will give out a mortgage, will extend a mortgage many times in its existence, right? So there's opportunity for trial by error on the lender's part that the borrower doesn't experience. So that we call consumer ignorance asymmetry. But if we turn to this creditor ignorance, the idea that the lender does not know much about the borrower, what algorithmic credit scoring, again, as a continuation of developments in consumer credit markets over the last 60, 70 years, offers is to significantly reduce, if not eliminate, that information asymmetry to the point where the lender knows everything about a borrower, in fact, knows more about a borrower because it can predict based on external evidence, data that I have no visibility over, how I might behave. So they know more about the borrower than the borrower could know about themselves. And this is not a phenomenon or an insight limited to credit markets. It's something that we can talk about in the surveillance economy, the surveillance society more generally. The idea that aggregate data analysis gives the people who have that data more insight over those who have created that data, or who that data really belongs to. So then the question is, if that's the change that we see in consumer credit markets, well, what is the impact and how do we assess that impact? The key argument I make in this paper from a normative perspective is to say, and this comes back to Ian's advice about framing the analysis, that how we think about this phenomenon and the impact of credit markets ultimately depends on your normative frame of analysis. What are your normative goals? What are the normative goals that we are assessing it against, and how do they trade off against each other and also within each other? So I highlight three main goals, and the reasons for selecting these is that they're drawn from, in some ways, the internal logic of consumer credit regulation and information regulation, which are the two main regulatory frameworks that are engaged by algorithmic credit scoring. So when I look at consumer credit regulation, certainly the European tradition of it, the EU tradition of it, the two main goals of the two main normative goals of that framework are efficiency and allocated efficiency and distributional fairness. And when we look at the requirement, which is in law to assess creditworthiness, it speaks to both of these goals. Efficiency in the sense that basically capital is being allocated to the projects that will value it most, so in a Pareto sense. What do we mean by distributional fairness is much more debated. There are different ways of defining it, but there is some sense that an efficient allocation is not necessarily a socially just one, and therefore there might be some need to redistribute or to ensure that certain groups, particularly those that are historically discriminated against, are protected or given special protection. Then there's also this third normative goal, which is privacy, and you can call it consumer privacy, financial privacy, and the sort of flip side of that of consumer autonomy. And that comes more from the legacy and the sort of heritage of information regulation or privacy regulation, particularly in Europe. And that's not really a logic internal to financial markets. However, it's engaged by algorithmic credit scoring. And the argument I make is that how we think about algorithmic scoring and what its impact is, whether we think it's a good thing for consumer credit markets or a bad thing, ultimately depends on which of these goals we're optimizing for and how we make trade-offs between them, because inevitably there are trade-offs. So I want to spend a bit of time thinking through what are those positive and negative impacts for each of these different goals. I'll start by talking about this from a more theoretical perspective, to say, well, in theory, this could be what happens to efficiency in consumer credit markets, and similarly for the other two goals. And then we'll go on to talk a little bit about some of the empirical findings, which are relatively recent, given this is a relatively recent phenomenon, and what they say about these different normative benchmarks. Okay, so on efficiency, well, so the first thing to say is that, well, surely with more information, going back to the informational asymmetry point, you have more information about the borrower, so surely now you can just discriminate more effectively between good, high risk and low risk borrowers. That should be a good thing, because capital can be allocated to projects that will be paid back, and you can avoid borrowers who are going to default on them. So more accurate risk-based pricing is an efficiency gain on the one hand. The problem is that, as I said before, if you know more about the borrower than the borrower knows about themselves, you also open up the door to inefficiencies in the form of rent seeking, in the form of price discrimination that may not be efficient. So here we're thinking about a lender knowing the consumer surplus and essentially pricing because they know that the consumer can afford to pay that, but that transfer of wealth from the borrower to the lender, and the investment that goes into making that transfer isn't necessarily welfare enhancing, doesn't increase economic output, and what economists would call as a deadweight loss to society. So that is not efficient, right? So there's definitely a trade-off between how the lender uses this additional information in terms of the efficiency goal. So what about distributional fairness? And distributional fairness itself is open to many different definitions, and there isn't there isn't one singular way of defining it. But if we draw some kind of high-level sort of insights, or some high-level conclusions about what the impact of algorithmic scoring could be, well, if we say that you're going to have certain borrowers can now, particularly those who previously were locked out of credit markets, can have access to it, that stands to offer a distributional fairness gain. And here I'm specifically talking about the fact that under the sort of existing or previous systems, much of credit scoring is focused on what we call credit data or financial data. And in many countries, at least I know in the US, maybe here as well, a large premium is placed on having a credit history. If you don't have a credit history, you might be called a thin file or a no file. But the irony is that by not taking on debt, you can't take on more debt. And that means that there are certain borrowers who are excluded from accessing credit and the sort of enhancements to well-being that might bring with it, simply because they just don't have enough data. If the contributionable alternative data in algorithmic credit scoring is to allow thin file yet credit-worthy borrowers to access credit, that could be a gain, not just from an efficiency point of view, but what we know is that most credit invisibles, most thin files, most no files are typically are predominantly ethnic minority communities. And so from that perspective, and if we use a kind of non-discrimination definition of fairness, this stands to benefit from a distributional fairness perspective. The other way is that you can see, well, there's an argument to be made that by moving the decision, the lending decision, out of the hands of potentially highly prejudiced and racist or sexist lending officers and transferring it to a automated, sort of quote-unquote automated system, you reduce the scope for discrimination due to animus, actual hatred against certain people or certain groups. So those are potential gains from a distributional fairness perspective. But there's also a flip side, right? Which is that you remove the human bias, but you potentially introduce biases due to the data sample not being representative enough, or simply because algorithms are not don't self-create. Humans create them, and the way that they're designed can easily just embed the biases of their programmers, of the designers. The other thing is this again, somewhat a paradox, which is that there is such a thing as too much information, right? And this has been described as the Hirschleifer effect after the economist who wrote about it, but it's essentially saying that in a world of some opacity, so some informational asymmetry, whilst it's true that people who are good credit risks are excluded from the market because people don't have enough information about them, it's also true that negative information is hidden as well, which means that somebody who is of a particular risk might be receiving a subsidy because some of their negative information has not been disclosed. So what could happen, and as we'll go on to see in the empirical part, may be happening, is that by revealing so much information, you actually increase the cost of credit for certain borrowers who may be more disproportionately amongst ethnic minorities, and that would not be a gain for distributional fairness. And then, of course, the sort of point that I made before about exploiting consumer ignorance. Again, if the consumer ignorance is born from financial illiteracy, if it's born from socioeconomic factors, and if those are correlated with socioeconomic status and ethnicity or gender, again, a potential loss for distributional fairness. And then what do we have to say about consumer privacy and autonomy? So you can see that here I have the most questions and the analysis is most nuanced. Clearly, algorithmic credit scoring relies on vast quantities of personal data. Yes, it could be anonymized, but not only has much research been done to show that most anonymization tools are largely ineffective at protecting personal identity, but also it's not the case that a lot of this data is anonymized. Inherently, therefore, seems that this is sort of privacy diminishing because it relies on large quantities of data. The problem with big data analysis is that the problem with data protection laws, at least in the European tradition, is that they are largely designed around this benchmark or standard of informed consent. And the problem with big data is that it's almost impossible to know what the secondary and tertiary uses of data are going to be at the outset. So whilst in theory there may be some kind of consent, most would argue that it's a relatively empty type of consent. And so we don't know that a person's privacy choices are genuinely being respected in that regard. The other point to make is that, again, if we go back to the idea that the lender now has more information on the borrower than the borrower knows about themselves, there's a sense that our autonomy to define our identities, to define our choices, is being slowly curtailed, quickly curtailed, as other people are preempting those choices for us. So before we have a chance to shop around for a financial product, a lender already knows what kind of financial product I want, and it's being directed to me and sent to me via an advertisement on Twitter or via an email. Of course, this is not new. Targeted advertising or targeted selling of financial products is not a new phenomenon. The point is that the new technologies afford the possibility to do this in a much more precise and accurate way that, in a sense, removes almost altogether the individual's choice. And this is a point that sort of was made by Bulgakov, which is that the individuality is replaced by the collectivity, right? So that the nature of statistical analysis is that it's based on the behavior of a group. Nothing inherently problematic about that, but of course it doesn't reflect the behavior of each individual of that group. It's the law of averages. And it could be that for a certain person or a certain individual, it's not the correct outcome, or it could be an unfavorable outcome, but on average produces the better outcome. So these are sort of theoretical suggestions as to what algorithmic credit scoring could do and the impact it could have on consumer credit markets. Now you might be asking, well, what about using the same technology in the hands of consumers? Why is it just lenders that we're talking about? And indeed, there are many ways in which these technologies are being applied. So new forms of data, new types of data, new data analytical tools are being used by consumers as well. So we can think of financial assistance, whether it's something that's specific to your iOS, like a Siri or Alexa, or something more specific. So in the UK, there is a financial assistant called Clio. These are personal digital financial assistants, and you could argue, well, can't we use the same tools to help the consumer to make better choices? So when I tell you that the lender is going to exploit my ignorance, well, this assistant will de-bias me, educate me, and prevent me from doing that. Likewise, I could use these tools to help sort those lenders who are abusing my personal data from those that are using it responsibly. In theory, I think that's a reasonable argument to make. I think there are a couple of practical hurdles. The first is that is the question of who has the best data, and the question of who is going to create this assistant and how effective are they going to be at countering probably a superior data advantage accruing to lenders. Not just lenders, but if you think forward a few years, and we're already seeing the seeds of that emerge, sort of the roots of this phenomenon emerge, is that lending is increasingly going to be done by the big tech companies, or what are often referred to as the tech fin rather than the fintechs. And if it's the Googles and the Amazons of the world that are the ones who are offering you the money, you know that there is almost no possibility, at least under the current sort of infrastructure, to overcome their data advantage. They have heaps and heaps of data. So that's one thing. And then the second thing is that, well, if you can argue that you could use these tools and apps to de-bias a consumer and help with their financial ignorance, but it requires financial sort of cognizance to choose to use an app in the first place. So unless the state or some sort of mandatory mechanism forces a consumer to download a financial assistant, or somehow forcibly puts a kind of veneer between them and the lender, you can't guarantee that these tools are going to help them. So there's an element of those biases affecting the choice to use these consumer helping tools in the first place. So I've largely been focusing on the theoretical, on theoretical suggestions as to what could happen. Well, what are the empirical studies saying? I mean, we are limited in some respect because this isn't not an entirely new phenomenon, but it is relatively new. Secondly, most of the activity in this space has been since the crisis, so since 2008, and so we haven't really seen a full cycle. And so, I'll speak to a fintech and they'll tell me they never had a default. Well, I don't know if that's because of the macroeconomic environment or because they're using some really sophisticated technology. And thirdly, there's also what I describe as algorithmic credit scoring encompasses quite a few different things. So there's lots of different types of alternative data. Utilities data has been used in the UK already, and that in some senses is alternative data. It's not strictly financial credit data. But there's quite a range of types of data and data analytical tools, which makes it hard to precisely test the hypotheses that that I'm putting forward. But nonetheless, we do have a few important studies that have been carried out in the last few years. I just want to highlight a couple of these. So one is Bartlett et al. And I can share the details of the papers. This is from a team at Berkeley. And they've looked at housing mortgage data in the US and somewhat reverse engineered whether there's discrimination at all in the existing data and what would happen if you were to use machine learning and alternative data. It's a really interesting analysis because the mortgage data, the mortgages that they look at are all government guaranteed, and so they use that as a way to kind of to assume where there could be discrimination because essentially the lender doesn't have to carry any risk on its books. But it's a longer analysis and one that's very interesting to read. Their main findings are that algorithmic lending eliminates discrimination in loan origination relative to face-to-face lending. And that's quite intuitive, right? So that if a lender is discriminating based on animus because they have some prejudice against a particular race or a gender or another class, then they're leaving money on the table. And so the move to algorithmic lending, and they interpret it as algorithmic lending as being almost entirely automated, so there is very little human interference in that lending decision. Then the animus-based discrimination is removed, and clearly the rational choice is to lend to a person regardless of race or gender if you're going to get a good return from them. But interestingly, what they do also find is that it doesn't eliminate discrimination in loan pricing, because there we start to see the effects of rent seeking, right? That when they can see that a particular consumer has a margin to pay or is likely to not shop around, then it's rational in some ways to charge them a higher price because they're going to pay it. So they find that algorithmic lending doesn't eliminate that. However, that fintech platforms do introduce more competition in the market. And so in general, not because of the algorithmic lending per se, but because of the proliferation of new lenders, there is more competition, and that is reducing the discrimination in loan pricing. The second really good analysis is by Fuster et al., which is a combination of people at NYU and at the New York Fed. And so they make the important point that using these tools, you do increase the accuracy of predicting defaults. So back to the point about this being more efficient because you can predict it more effectively. And that also has a distributional gain because you're generally increasing access to credit. But very interestingly, they find that those gains, so they say there are going to be basically, any new statistical technology will increase precision of prediction, but there's going to be winners and losers, and the question is how those winners and losers are distributed. What they find is that those gains are unevenly distributed. So the accuracy gains accrue disproportionately less to Black and Hispanic borrowers, and there's also a greater disparity in interest rates, so both within a group. So there's a large disparity between the highest risk and the lowest risk, and also between groups. Again, it's intuitive because going back to the points that we've discussed earlier, more precision means that you have the higher risks are also more precisely measured, as are the lower risks, and therefore you have some people gaining, but also some people losing. And then the last paper, which is from the Philly Fed, two co-authors there who've been writing some papers in the last few years, and they find using Lending Club data that the alternative information improved access to credit, so that for the same risk of default, Lending Club consumers paid a lower interest rate, a smaller spread. I'm conscious of the time, so I'm going to move on and now just address, before closing, what this means for consumer credit regulation. So I'm conscious that consumer credit laws are jurisdiction specific. I focus on EU law, and that informs a lot of UK law, at least for now. And so the points that I'm going to make are very high level, and I think are not specific to the jurisdiction that I focus on, but are more general than that. And I think there are three priorities coming out from this development in algorithmic credit scoring and algorithmic lending. So the first relates to the responsibilities of lenders with respect to using these tools. And the second and third relate more to empowering consumers to manage the effects of this socio-technological development. So on the first one, which is machine learning models and alternative data, I think a large area of research already, but one that needs to now focus a lot more specifically on lenders and credit providers, is to think about responsibilities for auditing the machine learning tools that are being used, in some ways similar to the regime that is applied to investment firms with regard to algorithmic trading. So stronger obligations to check that the systems are fit and proper, and that requires data quality, checking the quality of the data, ensuring that there is continuous model feedback testing, cross-validation, so all of the different sort of standard best practice that is used in statistical analysis in some ways needs to be introduced at a regulatory level for credit providers. Another interesting suggestion which is made by Bartlett et al. Is that the lenders also should be able to demonstrate the correlation between the variable that's being used and the life cycle variable. So basically to demonstrate why a variable that is being relied upon using machine learning or alternative data is relevant to a person's creditworthiness, and it's not a spurious correlation or something that we should be relying upon. The second two areas I mentioned are more about empowering consumers. And the first thing I think needs to be an important priority for regulation in this area going forward is to think a bit more about what we mean by financial privacy. Financial privacy has a relatively narrow understanding in the sense that it typically focuses in different jurisdictions, but in Europe you've got the idea of bank secrecy, and then you have sort of very targeted rules in the US, for example, that try to protect the privacy of consumers. Then you also have cross-sectoral laws like the GDPR or data protection laws in the EU that try and protect the privacy of consumers and individuals more generally. I think one thing that we need to think more carefully about is how to integrate and balance these competing regimes. That you have financial privacy, the financial data protection laws on the one hand, consumer credit laws on the other. And how do you balance these different goals, which is that a consumer's privacy can be protected, but is at the expense of the efficiency gains that we have discussed and the distributional fairness gains that we've discussed in terms of more accurate risk-based credit pricing and access to credit for particularly thin-file and no-file borrowers. How do we trade off these different goals? How do those two regimes interact? And I'll give you a couple of examples. The GDPR in Europe, which is basically an extension of the data protection regime that existed prior to that, includes two interesting requirements or rights for consumers. One which has sort of come to be dubbed the right to explanation, and there's a debate about whether that's really what it means. But if we assume that this requires some degree of explainability, then does that mean that we are limited from using certain types of machine learning techniques? And I'm thinking in particular of unsupervised machine learning, neural nets, that you don't necessarily know exactly what weights were attributed to each of the variables, or indeed which variables were used in the analysis. Does that right from data protection law therefore curtail the types of data analytic techniques that we can use in the context of algorithmic credit scoring? Likewise, there's a right to be forgotten, or what is actually the right to data erasure. Is there certain legitimate reasons, and how long should data be kept in the financial context, and what defines the right to be forgotten in the context of consumer credit, and is that different from any other sector? And then finally, there's sort of much work to be done in the credit information market. The way the credit information market operates in Europe, in the UK, in the US, and I'm sure in many other developed countries at least, is quite a relic of a past time. It basically operates as lenders sharing very specific categories of information relating to financial accounts and performance data, to what has now basically become three credit reference agencies, Equifax, Experian, and TransUnion, who have a sort of oligopoly in that respect. And they share that amongst lenders, and secondly, they produce credit reports. I have two problems with that. The first is that the data that's being shared in a world of algorithmic lending is clearly not all of the data that lenders are using. So it's possible to predict it's possible to derive most of predictable creditworthiness from financial data if a person has a strong credit history. But go back to our thin-file and no-file consumers, they simply don't benefit from that. Does this mean that we should now be sharing alternative data? What are the incentives or disincentives to doing that? And then secondly, the credit report. If you've looked at your credit report recently, as I have done, it doesn't tell me much about my creditworthiness. It simply tells me whether I've taken out a mortgage, I have not. It tells me whether I have any county court judgments against me, I have not. It tells me where I live, and not information that's particularly helpful for me to understand how lenders, in a world of algorithmic credit scoring, where they're looking at my social media activity and they're looking at how I've operated on their website, how they're making those decisions. I think a lot of work and thinking needs to go into redesigning credit information markets with a view to empowering consumers in order to combat the sort of worst of algorithmic credit scoring whilst leveraging its benefits. I'm going to stop there and open for questions.
I'm sure.